What is the most unique risk you've ever had to contemplate a price for?
You're worried about one person and whether they piss off one of their sponsors.
And you said reality TV, I can't help but point out Love Island, Survivor.
Capacity is all over the world. London market, European market, US market. In entertainment, we're thinking about the democratization of content creation.
Show speed. He did this one stunt. He jumped in the air and had a car like drive underneath him.
The Super Bowl, she is floating. There's these platforms in the sky. This is a real challenge.
Alexander, as actuaries, we help people understand what it costs to take risk, whatever that risk might be. And you're in a very unique position. You're an actuary in the entertainment space. First thing that comes to my mind is like, what is the most unique risk you've ever had to contemplate a price for?
Pretty exotic one here. We had a global celebrity that had, endorsement deals. They wanted to pre-monetize their, take a loan against the endorsements that are coming in, spend some money on something. So the risk there is what we would call disgrace. Disgrace insurance is something that pops up in film and television from time to time, especially in a soft market. Studios, content producers are worried about, am I going to find out something really bad about, person who's in my production, so I can't show the production and I wasted all that time. This is pretty similar. So in this case, we had to look at the promo deals, the endorsements that were coming in, who those sponsors were, and sort of what their issues would be, and to underwrite, can we see these endorsement deals lasting long enough that we can get off risk in time to, make sure that this loan is secured. You're worried about one person, their behavior, what they're going to do, and whether you can support a whole bunch of money that's going to depend on whether they piss off one of their sponsors. That's definitely one of the more interesting things I looked at.
What are some of the exposure dynamics that you think of, like when you think of how the risk can be mitigated?
I mean, a financial deal like I just referred to, you're really looking at the structuring of the terms and loan repayment terms, contractual triggers, things like that. Entertainment has a lot of contractual triggers. I'm sure you've heard the Brown M&M's story from, is that Van Halen? Oh, I can't remember. The concert rider where, if the, you got to have so many bottles of this and so many snacks like this, and you got to set up the speakers this way and the stage this way. And there's a famous story where one of the bands said, well, give us a bowl of M&Ms, but no brown M&Ms. That was a risk management device because they're trying to say, if our venue was not careful enough to read the thing and take the brown M&Ms out, who knows what else they screwed up. So contracts are everywhere in entertainment insurance. So we were talking about music. Yeah, you've got country music, rap music, pop music, big. We're sitting here looking at crypto.com. The shows that go on in there have so many people involved, so much contractual risk transfer between the promoter, the venue, the artist themselves. And the artist is not just an artist, the artist is a company. Your favorite artist has so many people supporting them, a corporate structure around them. But what they do as an individual and what their entourage does, the people around them do, that influences their liability. So meandering a little bit here, but with live events and with what we call shell and touring, that's the artists themselves, who they are, how they behave is a huge part of the underwriting. And, you can bucket them into genres to some extent, but you got a bad boy in every genre, you got a bad girl in every genre. You just got to be careful with what you're doing.
Me and my girlfriend, we just actually went to Jimmy Kimmel. So I think back to, was it Rihanna? Some celebrity was talking to Ellen about the rider that they have with like you said, the brown M&Ms for Bon Jovi. So
I have a funny, a couple years ago, I'm at my friend's house. We're watching the Super Bowl. I think it's 2020, 2 years ago. Was Rihanna on the Super Bowl 2 years ago?
Yeah, 2023.
So halftime show, we're just having a good time. We're drinking some beers, doing some barbecue. And the halftime show starts. And she comes out and she is floating, like there's these platforms in the sky. And also, this might have been when she first revealed she was pregnant.
Yes.
Like I was shocked. I was like, I hadn't been paying attention exactly, but she looked very pregnant. I call up my underwriter and I'm just like, are we on this? That happens all the time in entertainment. You're curious. Like I see this thing and it's a potential insured. Maybe we underwrote it and thought it was great and saw there's all kinds of risk prevention measures and all of the design is there. Maybe we just weren't comfortable and avoided it, or maybe we were never presented the opportunity in the first place. It's a pretty small market, this entertainment space, but any of those things could be possible.
We're in what I would argue is one of the entertainment capitals of the world. It's not quite Vegas, but I would argue we're certainly one of them in LA.
Certainly for film.
Yeah, for film, for sure. Now, when you think of entertainment, people really think of actuaries when it comes to entertainment. You're one of the people who help make the show possible, even if behind the scenes. So walk me through what that looks like.
When a producer is working on a documentary project or just a short production or a feature film, you have to get insurance. As you can imagine, insurance is probably one of the last things that people are thinking about. They need their set, they need their location, they need their people to show up, madly scrambling to pull production together. But hopefully insurance has been thought about. This is where the brokers in this space there's a very small number of brokers in the entertainment space. You could throw a cocktail party and fit them all in this studio, Dominic. But they work really hard at all hours of the day because insurance has to sign off on, in a big picture, everything that happens. There's a method for doing that, but any given production is going to need casualty insurance. You're going to need workers' comp. You're going to need, which is sometimes done through payroll service instead of actually through a policy. The key thing is the portfolio. Portfolio insurance. It's very unique. Inland marine. We love our inland marine insurance because it could be anything. You're covering everything from your equipment, your props, your sets, cast exposure. Is your cast going to show up? Is your crew going to show up? Do they get sick? Does someone get killed? God forbid. Third-party property damage. I mean, if we made a wreck to this studio right now and you had the typical portfolio insurance, there's actually been a casualty thrown in, almost like a fire legal kind of cover. The people you're renting the set from, they want to know that you're not going to destroy it and walk out of there and they're not going to have it fixed up. So there's a wide swath of coverages. Again, meandering a bit, but, production company working with an insurance broker, specialized insurance broker, big names you've heard of, but also smaller specialty shops. They're working with underwriters. They could be at carriers. There's a number of carriers that do this business. There's also a number of MGAs in the business. So MGAs, carriers, MGA has paper behind them. That's the insurance company, as you know. And for bigger risks, reinsurance comes into play. So you could have a policy for a shoot happening right here on the street in LA, and ultimately the chain of risk is going to the US, to London, to Europe, and being spread around the world in a whole panel. It's kind of interesting to follow the dollars and where the risk goes if it gets big enough.
Before we go deeper, let's actually take a step back because the word entertainment came up a few times. That's really the theme of this episode. We're in Los Angeles. When people hear entertainment, they often think of grand gestures and spectacles. Like, how do you think of the word entertainment?
From a segment point of view, we're talking film, television, what we call DICE, which is more like TV commercials and documentary producers. You got your live events, concerts, venues, touring artists, celebrities, personal risk. You also have rental houses. This is like event production services. So somebody has to bring all of that camera equipment, lighting equipment, staging equipment to the place or have that equipment available for rent. So you have a ton of different segments. You can go into sports, amateur sports, professional sports, motorsports, boating, all kinds of things. Entertainment's really unique because unlike areas of commercial insurance where, a factory, they make a thing, or a restaurant, they serve. Entertainment could be anything because it's not really defined as what it is. It's defined as it's for an audience. This is a challenge with actually explaining these products to regulators because they're so used to like a factory does this, a restaurant does this, a hotel does this. A TV producer could do anything. It could be two guys talking. It could be sending people out into the Amazon jungle naked to see if they survive for a month. The reality TV space has some outrageous things, outrageous risks that we've had to see. The definition is it could be anything, but it's done for an audience.
And you say reality TV, I can't help but point out Love Island, Survivor.
I can say this because it's been a long time, but I think the way that Jersey Shore was first described was not exactly what it turned out to be.
Oh, yeah.
I'm from Jersey. They've done some crazy things. Even the nature documentaries, too. Animals, are not cast members. They're not scripted. You don't know what's going to happen. Everybody remembers, Steve Irwin, rest in peace. It's a dangerous world.
We had a really interesting conversation. You mentioned it's there's a balance between financial risk management and physical risk management. In film production, having to stick to the budget and potentially having to cut corners depending on things like inclement weather, etc. I thought that was really interesting.
If I break the world up, as we tend to do where I come from, into production and live events, on the production side, you're dealing more with first-party risk. I'm the insured. I had a loss. I need money to pay for my loss. On the live event side, it's more casualty, liability. Someone got hurt at my show. I'm going to be held responsible. Or I'm going to be accused and I'm going to need the duty to defend and protect myself even though it wasn't my fault. Both production and live need first and third party covers. Everybody has equipment, but everybody has casualty exposure. When you're dealing with hundreds, even thousands of spectators on the live event side, that's a much more concentrated casualty risk. When you're dealing with very big, complex, shooting schedules, potentially very expensive props and vehicles, that's more first party risk on the production side.
Game of Thrones, I think, had some really interesting dollies and kind of jibs.
I've worked on all of the major studios, so I can't speak about this particular thing, but I do recall weather events that impacted Game of Thrones, years ago. What's really interesting about that era, Dominic, for the longest time, we were rating productions per episode. You have typically a certain amount of budget. It's kind of predictable. Even back when they're making Friends or Seinfeld or any of these shows, like there's a pretty predictable budget. HBO came out. You had the golden age of television, starting with The Sopranos. I loved The Wire. You had these different shows. Game of Thrones, the budget started creeping up. And now what looks like a TV show really looks like film production. The budget for my episode is 2, 3, 4, 5 times what it was some years ago, but my premium is still rated per episode, and that's a problem. So we sort of had to convert rating things on a budget instead of just saying, an episode is an episode is an episode. And this exposure-based kind of stuff, it can be a little nerdy, but, in insurance, we're going for pretty thin margins. Loss ratios in property casualty insurance, you're lucky if you're down in the 40s and you're probably feeling okay in the 50s and you're starting to hurt in the 60s. If you have something that's impacting your margins by 100%, you're toast.
When we think of some of the coverages that might be more unique to the entertainment space, I imagine you may have some interesting examples.
It's all kinds of production. So you've got TV commercials. You've got car companies. Car companies are bringing their cars out to the desert, the mountains. If you're going to drive a car and drive it kind of aggressively and make tire marks on the ground, are you responsible for those tire marks? Are those tire marks and the damage you do to the track you're on, is that accidental? Should that be covered by insurance? So a lot of the times you have items that are sort of predictable losses. Say you mounted a camera 3 inches off the ground because you wanted to get that really cool shot, and guess what? It bounced on the ground and it broke. Some people are going to try to make an insurance claim for that. Problem is, it's not an accident. It's really a cost of production. So one of the things that we have to be careful about is to not be paying claims under insurance that are really, they destroyed something sort of on purpose or intentionally as part of the production process. Cast members are infinitely interesting. Every person is a person. They have their own travails. What these people do in entertainment it's not for profit. It's for spectacle. So the risk management aspect is just a little bit different. Drones were an interesting one. You remember, Dominic, 10 years ago, you started to have a drone, 1 or 2. What do you do with the drone? There's a whole discussion in the insurance industry about, is this an aircraft? Does aviation liability apply? How does that even work? We were looking at the FAA for guidance. But now you have hundreds of drones up in the sky. Imagine if all those things fell, a hacker came in and all those things fell and pelted. It's one thing to have one drone, 5-pound drone fall. It's another thing to have 100 of them fall on an audience.
Recently, actually, at a networking event, I met a guy who manages a drone fleet, and they'll do shows like things like 4th of July parades and events, I guess live events as well.
What this makes me think of, though, is, innovation is something we see in the entertainment industry. Yes, there's new ways of manufacturing. Yes, there's new ways of serving customers in whatever retail segment, maybe some robots now. But in entertainment, they are always pushing the envelope. And so you're seeing risks on your desk, the underwriters are, that maybe nobody has ever tried to do this before. And so how can you accept this risk? And from a pricing actuary's point of view, people think we're magic and you have a magic wand and you can just come up with the right price for anything. A lot of people thinking what actuaries do are really thinking what underwriters do, is to eyeball, assess a risk, attach a price to it. A lot of the time, we're just watching the results of this process. You have a whole book of dice business. You have a whole book of shell and touring business. And how am I going to apply the actuarial techniques of rate making, loss development, trend, watching my ALE, my claims defense expenses, applying my on-level factors for that amount of historical pricing change that I can watch. There's tools in the toolbox that we can apply to the portfolio. But just because I'm an actuary doesn't mean I know the exact right price for this aircraft stunt they're going to do. That's actually the underwriter's job. And I think in the industry, sometimes we're concerned about acknowledging that underwriters actually make thoughtful, rational, hopefully rational, calculated decisions to some extent about pricing. Pricing is not just the actuary's job.
When we think of actuarial work in the entertainment space, like how much of the standard toolkit would you say carries over, and what areas of evolution need to happen for actuaries to be effective in the space?
Entertainment's definitely a specialty line. There's many specialty lines of business out there. Aviation, energy, space. There's many, marine. Anytime you have an account that's large enough and has enough repeated experience, you can do fun stuff like price deductibles, do some frequency severity modeling, and even pricing like aggregate deductibles. Any good corporate risk manager is always trying to reduce the amount of insurance premium being paid. Every dollar of premium, everyone should understand that if someone's targeting a 50% loss ratio, just for instance, every dollar of premium you paid, half of that is going to admin. So the customer is always going to want, a nice aggregate deductible if they can afford that. So some of those stochastic techniques are very possible. The traditional reserving absolutely has to have been done. And when you're dealing with casualty lines, we have a huge amount of GL. We have a huge amount of fairly typical auto liability. So you have to be watching your auto development and trend. You have to be watching your GL development and trend, your ratio of ALE to indemnity. Are there certain types of claims that can just blow you up in terms of defense costs? Personal injury is sort of a weird word. Personal injury more means like, defamation, saying, when you get into a lawsuit about words and ideas and things people said, the defense costs on those can just go through the roof. Excess casualty, increased limits factors. This applies just as much as anywhere else. You have to, sometimes price layers that have never been hit before and hopefully might not ever. So there's absolutely a ton of traditional toolkit that you're going to see on. Is it still exam 5, exam 6, sort of that basic pricing, basic rate making,
exam 5.
but applying it into the specialty space. As you can imagine, movie studios have enough business over time that you can sort of experience rate a little bit. But classification is difficult. A lot of personal lines actuaries are very used to developing classification systems that are very fine, very detailed, that have generalized linear models that apply a curve on age of vehicle and on zip codes and on 10, 15 different factors. The challenge in these specialty lines and the challenge in entertainment is just pinning down, what is it I'm looking at? If you have the world of music, are you going to group them by genre?
Yeah.
I mean,
lots of assumptions there.
Yeah, I mean, how do you even group people together into categories that make sense? This is a real challenge because you and I might not even agree. I mean, Dominic, is Beyonce pop or country?
Is she pop? Well,
she had a crossover album. If I recall correctly, they split the award category into like sort of a traditional country and
recently.
Yeah, it's like people are just doing different
Very
things.
suspect, yeah.
People will denigrate hip hop and rap for probably being a more loss-driven space, But you have some folks who are doing, is anybody going to give Questlove a hard time? I don't think so. Not our client. I'm just talking about out in the world. This is probably a good time to say, I'm a portfolio manager and an actuary at Applied Underwriters. We have an entertainment platform out there called Applied Entertainment and Sports. We've been around for a couple of years. I'm here talking to you just from my personal experience. I mean, I'm a CAS actuary. I've been a CAS actuary since 2010 or so. What I'm talking about does not represent my employer, but it's fun to be in this space, to be here in Los Angeles and working on these kind of subjects and being able to bring an actuarial perspective to something that people don't normally think about.
You talked a lot about the classical techniques and what translates. In terms of thought process, like what do we need to think of as actuaries to be able to properly price and properly manage the exposures within this particular space? Things that the traditional toolkit may not sufficiently capture.
When you're serving a customer segment, you have to be all things to that customer. So yes, in this direction, you have unique cast exposures. You have unique filming and weather exposures that are only for film and TV commercial production that, you're not going to see anywhere else. On the other hand, you're a touring artist. You still drive cars. You might drive a Mercedes SUV, but that is very standard auto insurance. In this space, we have to be able to, do a good job at providing regular old commercial auto, 1 million combined single limit auto insurance, pretty typical workers' compensation. You have to be able to deliver and, the standardized difficult stuff. And I say it's difficult because it's very complicated. I mean, you have whole companies full of actuaries just managing. I mean, I would hate to be, forgive me, like personal or commercial lines auto manager for 2 states or something like that. It's a good job and it needs to be done, but just that level of detail to get in there and do it right. We have to deliver that to our customers at the same time handling all the weird stuff. So putting it all together, you get sort of a ball of complexity.
Any actuary understands that judgment is a really big part of what we do. I imagine there's a lot of room for judgment when things don't really fit neatly into one particular space.
One thing that comes to mind from the actuarial discourse is, credibility versus homogeneity. And how do you manage your portfolio? How do you cut it up? What's similar to what? From a rate-making perspective, maybe you can group all of your commercial auto together and treat it with a certain development pattern. Maybe you recognize that hired and non-owned autos, which are, rental vehicles being used by production, they're renting vehicles, they're driving around places they've never been before, they're driving late at night, sometimes it's production assistance. You know enough to say, well, this is potentially a different risk than the owned vehicles being driven normally. With actuarial hat on, I'm going to try splitting my experience, identifying that segment, and, looking at it. Doing a loss ratio projection for this segment versus this segment. Also, the pricing structure may be different. There's a lot of opportunity to manage your portfolio as a pricing actuary and figure out which pieces are worth looking at and which things do I just sort of let squish together. The judgment involved in knowing the business enough to see which pieces might be relevant is a bit, interesting.
There's a bit of a blurred line between the pricing and the underwriting, or at least there seems to be a little bit of an intersection. How do we draw the line between what's reasonable and what's essentially uninsurable?
As far as I know, I may be the only pricing actuary. I worked at Fireman's Fund, Allianz for a long time, and that was maybe the only place that had a big enough book of business to support a full-time actuary. A lot of the carriers out there will have they have actuaries assigned to that business, but it might be a part-time job or a bit more segregated into functions. So I don't actually know anyone who's had a similar path to me in terms of picking up on the underwriting, also having the actuarial responsibilities, kind of a bit. The only one in Los Angeles, I know that.
Yeah.
But in terms of what's insurable, what's uninsurable, I think an interesting way to look at it is 1, by coverage, and 2, by who you're dealing with. And so by coverage, I mentioned disgrace insurance in the opener. Fundamentally, do you want to insure disgraceful conduct of people that you may have little information on or little control over. That could beat you up, and also if you have a claim, you might feel that you didn't really have the information to evaluate the risk. The question is really, is there an adverse selection problem in that segment? So you could look at that segment and say, maybe this is a class of risk that could make sense. Maybe this is a class of risk that inherently has too much adverse selection to deal with, or maybe I have a secret sauce to kind of marry those two. On the other hand, the attitude that people have running a business, I think, is even more important in this space than in any other, because there's no degree or qualifications or particular path to becoming successful as an entertainment. And I'm talking about the business itself, not the insurance. A great musician might have just sung a couple great songs and took off, and now they're a huge celebrity. I sort of think about like Mark Zuckerberg even. He's a kid at Harvard, and he created this software platform, and now he's one of the richest people in the world with all of the ethical burdens that are attached to that.
Sure.
Our underwriters are always looking at, do the people being presented for insurance and their companies have a track record of safety consciousness? Are they trying to be safe? Are they watching out for their people? Are they and the public? This is not something you can quantify. Well, you can, because if you have a loss history and, gosh, that claim should have never happened. I can think of a couple like those, as I'm sure we all can out in the public space. That's one thing that's telling. But yeah, I think that fundamental attitude of safety consciousness and, do I care about safety, or do I only care about the result and producing this thing and damn the consequences? That's where that judgment of insurability comes into play, in my opinion.
You talked about, different entities taking a share of the risk. The broader ecosystem has many different players. It could be the customer, the insurer, brokers, general agents, reinsurers. So how do you think of the ecosystem, the value chain, within the entertainment ecosystem?
It is kind of funny that a dollar of risk can pass through so many hands, but I really have come to see over the years that each of those steps adds some really helpful value. I'll speak briefly on the broker side. There's generally a lot of very specific brokers who specialize in this space, who've made their name in the space, maybe a dozen or so, and most of the business flows through those brokers because they know the specifics. They know how to talk to an entertainment client. They know the concerns. But a lot of entertainers have a friend or family member or just someone they trust for their insurance, and that's where the wholesale broker comes in. So I have a friend who his whole business is to basically be that wholesaler, that entertainment broker for regular insurance producers that don't know the space too well. So they'll work together to get the right coverage identified, to get the submission into the right markets, and the policyholder, the insured, gets to work with the person they trust and know. But also the wholesaler here adds the expertise and the industry-specific knowledge that is needed. So that's kind of on that end of things. What most folks don't see if you're not on the carrier side, I mean, this is completely normal for carrier people, but we're working with reinsurers. So capacity is all over the world. I mean, you've got London market, European market, U.S. market, but there are insurers who they want to provide you risk capacity, quota share, excess of loss, whatever it may be, and support the underwriting that you're doing as a carrier or as a carrier as an MGA or however your setup is. Getting treaty support in this space is not really different from getting treaty support for any other specialty or commercial line. You're working with a broker who knows something, knows which markets are interested, which reinsurance markets are interested in this business, helping you put together a submission. What are reinsurers going to want to know? The same thing they want to know about anything. What has the rate change been? What is the historical performance? What do your losses look like? What changes are you making in your portfolio? In a way, it's exactly the same as placing any other kind of auto, liability, workers' comp, any property, any kind of treaty. You build a trust relationship over time, and they always bring in the actuaries to look at the data and ask some tough questions. And really, I think the role of the actuary in these transactions is to be a bit of an objective role because you put an underwriter and a reinsurer together who want to work with each other and they want to work with each other. It makes sense. Actuaries can play a really nice sort of scientific role, checking numbers. Is this data making sense? Do you see any flaws? Do you see any holes in it? And make those recommendations to the more business people in the transaction. There's a huge market for reinsurance that impacts all of these coverages, and it's probably just like any other reinsurance market, which is you're either completely used to it, or maybe you just never see that kind of thing at all.
As someone who's actually recently, we won't get into too many deals, started working with brokers myself, do you have any ideas or any tips on how to work with them effectively and how to work collaboratively?
Brokers can have different attitudes. Some retail brokers are underwriters at heart, and they want to know their loss performance. They want reports. They want to know which accounts have been driving losses. They want that information. Other brokers are brokers at heart, salespeople at heart, and the approach is more about throwing business at the markets, getting the best deal they can for their customer, and maybe switching markets if they have to, someone will take the business. So it's just two different attitudes towards producing, both valid and both works. And I think what's great about the insurance ecosystem is that we have expert professionals in different roles all being put together to provide something, that at the end of the day is very special and very necessary in commerce today, which is, the protection that the policyholder needs at the end of the day.
And would you say that the brokers help you to enhance or shape your understanding of the risk?
A good broker's job is to present the risk to the underwriter, and sometimes the underwriter will consult with actuarial and et cetera, but to explain what is this risk doing. And in particular, in the production side, if you just say, I'm producing a TV commercial, that could be anything. What information can you provide? Can you communicate it clearly? Can you anticipate questions that the underwriter is going to want to know? It's really about that communication aspect. This is not a segment of insurance where you just fill out a standard application and answer these 12 questions and that's it. It's collaborative because there's so much innovation in the space and there's so much heterogeneity between risks that it's very difficult to describe just what is this company actually doing in a way that's quickly understandable and quickly reactable to.
Now, working relationships can evolve when conditions change, and especially when they change quickly, which brings me back to 2020 and the pandemic. So take me back to 2020. What was that like for you?
I do remember grabbing my monitor from work, and my nice big monitor, and bringing it home and then never coming back. Yeah, it was a scary time for us in particular for two reasons. The event cancellation space, the contingency market, took enormous losses from COVID because obviously every public event needed to be canceled. And the London market writes a lot of what we call contingency insurance and event cancellation, non-appearance. That's when you have a concert or a festival, and usually you're worried about weather, or on the non-appearance side, you're worried about the artist getting sick or all of a sudden having a vocal problem or something like that. The event cancellation market obviously took large hits from the public shutdown. And I recall that in England, they even had I think they were trying to do like a pandemic recovery fund or act. I don't recall all of the details, but they were definitely treating the pandemic a bit more seriously than we were in the United States in terms of trying to get the industry back to work from a governmental perspective. Now, in the film and production side here in the States, obviously, also every production had to shut down. And that's a bit scary too, because one of the things we worried about in insurance and reinsurance is aggregation. Only speaking for myself, I certainly, I'll admit, I had never thought about epidemic, pandemic as a potential source of aggregation. The last one had happened in 1914? Spanish flu or...
Yeah. Actually, I think it was like 100 years before, maybe.
It's
roughly
100 years
before, yeah.
We talk about 1 in 100-year risk all the time.
Yeah.
But it's usually localized, like a flood risk or a hurricane risk. Well, it's 1 in 100 for this particular spot. To have something that's actually a global or countrywide 1 in 100-year risk, It's difficult because the incentives in the system are just not set up to really price that in. Nobody's going to want to pay an extra 2% for something they think is never, ever, ever going to happen if they've even considered it in the first place. The disruption of, okay, all of a sudden everything's going down, claims are flowing in left and right. God bless our claims manager working day and night. But despite the vast amount of claims coming in, I have some personal pride in just this was a chance for the insurance system to step up and pay. I grew up at Fireman's Fund. We had a great story back then about the San Francisco earthquake and paying all of the claims. Half the city burned down. This is another historical example where, individual corporate P&Ls aside, a lot of financial risk was mitigated through insurance company balance sheets. Now, a lot of these types of risks, now that you know about it, now that you're cognizant of it, is that same black swan event going to get paid for in the same way? Again, I doubt it. I mean, coronavirus exclusions are standard in the industry now, as far as I know, for good reason, because it's not something systemic like that is not insurable as a free throw in, by the way, kind of item. It has to be specifically managed. Just like earthquake, the expected loss ratio on earthquake has to be low because when it happens all at once. From an actuarial perspective, we know that means an expensive cost of capital. So similarly, pandemic, expensive cost of capital.
I'm from the Caribbean, and entertainment, it's a very entertainment-centric place. In particular, we have Carnival, kind of like Rio has Carnival. There's a Carnival, I think, that got delayed by 2 years.
I went to Trinidad Tobago Carnival a few years ago. That was a lot of fun.
Yeah.
Very interesting.
It was a tough time for them because that's in Trinidad in particular, Carnival is a year-round industry. How do you see the pandemic kind of reshaping pricing and underwriting for live events, broadly speaking, on a global basis?
My gut reaction is this has probably changed how the actual clients manage themselves. I mean, and this is a good thing. Part of our role in insurance is not just to buy risk off people, take risk off their hands. It's also to provide a signal in terms of where investing more in safety is a good idea. And if hygiene on set, if testing, if being careful is in the interest of the client because they may not have full insurance cover, I think that's a valuable thing that we provide, because paying an insurance claim is one thing, but preventing the chute from going down in the first place, preventing people from getting sick and ill and potentially, dying or being injured, all of those things, insurance money is never good enough. It's just one way we try to offset the underlying problem that happened. I would say the same thing on the live event side. You talk to any of the live events underwriters who've been around for a while, the safety consciousness of, how professional is the industry, how thoughtful is the industry, how trained is the industry in terms of putting up staging, in terms of weather protocol, safety protocol, who's making the decision to shut down a show if the weather gets bad. 20 years ago, you could say it's obviously a game of hot potato. These days, much more likely to have a very set protocol, and that's just good for public safety. So I'm very proud of the role that we in insurance play in terms of public safety.
So would it be fair to say that we as a society, we're better equipped to manage this type of systemic risk?
By nature, as humans, we don't take things very seriously until it's happened. It's Cassandra syndrome. You can all day long say that the sky could fall, something's going to happen, whether it's a cyber event, nuclear war, any of these things. But until something actually happens, people don't really want to react and change their day-to-day and invest more money in prevention or mitigation or even pass public policy. When's the last time Congress did something that was forward-looking as opposed to reacting to a crisis?
The pandemic, it has certainly reshaped the market in profound ways, and it's also accelerated change. Content creation, for instance, has advanced tremendously. I prefer content creator, but some people say influencers as well.
You're such an influencer. Maverick actuary, love it.
We have to cut that part. Well, yeah, influencers, content creators, people in esports. Some of these folks are becoming fully blown media companies. How's the industry reacting to, I guess you could call them emerging and evolving risks?
In entertainment and the entertainment industry and the insurance space in particular, we're definitely thinking about the democratization of content creation. I mean, back in the day, there's sort of a series of walls or a series of I don't know, safeguards, if you want to call it that. But, you have agents, you have production houses, you have record labels, you have all these managers. Today, though, anybody can spin up YouTube and with a lot of money or no money, put video content out there. And it's becoming enormous, as we all know. The risk, though, could be huge or could be nothing. I mean, it's so difficult to measure because there's no track record. So new folks who have maybe zero experience or maybe also a mindset that's more about getting views than doing things safely. The thing that scares me, all of these videos of people walking up to, let's say, drunk people on the street in Nashville or in Miami or wherever, and just trying to get a reaction out of people. Do they have legal support? Are they getting media releases? Are they? Is there defamatory content going on? Like, it's a bit scary. I wouldn't be necessarily comfortable without seeing a lot of experience data as to how those kind of accounts would perform. But also, when you have less managers in the picture and more straight self-published content, people don't naturally think about insurance. They don't naturally think about risk. They think about top line and views. And so until you've been burned, I think the safety consciousness, especially for some of the younger folks out there just doing content for the first time, is not there. The other challenge we have is going back to that classification, that actuarial topic of classification, which is, hey, I have a content creator. What does that mean? Is it a podcast episode? Is it a cooking show? Is it a unboxing person? Is it someone that bought a giant train and dug a giant hole and decided to drive the train into the hole and blow it up with explosives? I mean, just the things people do of their own volition for the gram, have you, all over the place. So I go back to a good insurance broker plays that role of a bit of a risk manager, at least advising on the type of coverage that folks need and expressing that. But it's the democratization piece is awesome, but it's also very challenging because it's the boxes are not so clear anymore.
Mr. Beast with Beast Games. I think they broke a bunch. I forget how many. I think he broke like 100 Guinness World Records because of the number of cameras that they use. It's just, I don't know if you know iShow Speed. That's a young guy who does this one stunt where I think he jumped in the air and had a car like drive underneath him. It was just insane. It's really interesting. I wonder if there's maybe this goes beyond the scope of actuarial, but I wonder if there's like an emerging industry in reaction to some of these things.
What I think about is, and it sounds like a dull topic, it's not, but contractual insurance requirements. I mean, to get a venue, that venue is going to make you show a certificate of insurance with $1 million limits. To rent equipment, that equipment rental house is probably going to make you show a certificate of insurance. So from a sort of a safety promotion gatekeeper point of view, the fact that we as an insurance industry sort of support and will grant coverage to folks who can demonstrate that they're taking their work seriously. And we may choose to decline folks that are not presented as taking their risk seriously. The result of that is that person may not have the certificate of insurance they need to take on the responsibility of a venue, to take on the responsibility of equipment. And so some of these little requirements that are out there that might seem onerous to a producer or annoying or why do I need to do this? They're really there for a good reason.
We've covered quite a bit of ground in this episode. I think I have a really good understanding of the ecosystem itself, of what entertainment means, of how actuaries and underwriters interact, how you work with the reinsurance brokers, what the pandemic looked like, emerging risks. Let me ask a couple of questions, maybe forward-looking questions. If you were to write the next chapter in the for the actuarial profession when it comes to the entertainment industry, like what would that look like?
As I mentioned earlier, I'm at Applied Underwriters. I've been there about 3 years. We've been growing all sorts of new specialty niches, and it's so interesting to see these new businesses develop. So I've had the privilege of working with a great team at Applied Entertainment and Sports. Our customers don't just need, the most exotic cast coverage. They also need vanilla old commercial auto and GL and workers' comp and property and all of those things. So to sort of build out some of these things in a new way, in a way from scratch, has been very fun and valuable. So I'd really like to see what we can do with this platform and grow it and become as successful and as customer friendly, and just make it easier for people to do their jobs. Insurance never exists for insurance's sake. It's simply an enabler for people that are out there and doing something physical and real in the world. We're there as a safety net.
We'll end on a profound note. This is my best effort at a profound question is, what has entertainment risk taught you about life?
I took a statistics degree in college. My dad's a civil engineer, very left-brainy, linear, boxy kind of which is exactly what you want when you're, calculating loads so that a tunnel doesn't collapse on people. The journey of insurance through specialty lines and entertainment in particular has taught me to be more perceptive and more patient and thoughtful. You don't create a rating plan and then try to just throw stuff into it, whether it fits or not. Over the long run, you need to very carefully observe the territory and be a bit more organic and a bit more, just integrated, holistic about treating risk as something real out in the world that you're observing, as opposed to something that just lives on a spreadsheet.
I couldn't agree more. And I really enjoyed this episode. This has been a while in the making. We spent some time, but it was well worth it. I think one of the things that we're going to do, I'm hoping, and I know that we'll do, is inspire actuaries to know that they can work in really cool spaces, that they can add value in ways that they might not have thought they could. This is the first actually in person, both people in studio episode. So I enjoyed meeting you, Alexander, and looking forward to keeping in touch with you.
Yeah, well, it's great to be here in LA, and I love what you do, Dominic.
As always, let's keep in touch.
Fantastic.
Alrighty, thank you.